Good afternoon, my people. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I welcome each and every one of you to episode 154, Bear or Bull Markets and what they mean to you. But before we get into that, I got to practice the attitude of gratitude and thank each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook page and the Wealth Our Way Network YouTube page. Please don't forget to subscribe to the Wealth Our Way Network YouTube page. I also want to give the Wow Nation salute to every member of Wealth Our Way Nation who watches this program pre-recorded overnight, over the weekend, on their lunch break, wherever you can squeeze 15 minutes of financial literacy in. And then a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. Peep this. Big Tank does not take a lot of time for himself. I got clients, I got kids, I got just, so much weight on these broad shoulders that I don't normally get a break. This week, I am going on vacation. So we're going to do 15 minutes of finance today, Tuesday, May 24th. We're going to have the Financial Power Hour tomorrow, which would be, Wednesday, the 25th. And then we are not going to have a show on Thursday, Tuesday, or the next Thursday. So we are going to not have the Financial Power Hour on Thursday, the 26th. We will not have it on Tuesday, the 31st, and we will not have it on Thursday, June 2nd. There already is no Financial Power Hour on alternating weeks. So I wanted to get that housekeeping note out there. I'm going to be sipping Mai Tai somewhere nice, relaxing, getting some sun, letting my financial mind rest a little bit, and I will be right back at you. My birthday is Saturday, June 4th, so I'm going to miss you guys for that. So happy birthday to me. But I will see you guys on Tuesday, June the 7th, as we get right back here for 15 minutes of finance. So the stock market's been going crazy. Inflation is crazy, so the bond market is reacting accordingly. We have war across the globe, so the commodities markets are unstable. And then, of course, anybody who's doing anything in cryptocurrency knows the stomach upsetting volatility that's been going on there. So there just seems like there's nowhere safe. We talked last week about cash being king, but I wanted to take a deeper dive into this because there's been so much talk about whether we're going into a recession, whether we're going into a bear market. And I wanted to just kind of talk to my audience about the difference between a bear market and a bull market. So a bear market is one where stocks have a decline. Now, there's a couple of different metrics that people normally measure. They can measure the sharp decline in the value of stocks, like a 20% drop, and say we're in a bear market. But I like to, not to go against the financial world here, I like to look at a bear market as a more precipitous drop or a more lengthy period at a lower amount from its highs. So, we use these terms because they sell newspapers. They make you turn into TV shows like Crash and Soar and Plummet. But the reality is that if a market goes down 20%, like we saw in March of 2020 with COVID, but bounces right back, technically, we went into a bear market for a week, but we came right back out of it. So I look at a bear market as more protracted. Same with bull markets. Now, fortunately, for all of us who are trying to amass wealth in this country, the bull markets last a lot longer than the bear markets here. What happens normally is we'll have a period of growth, i.e. a bull market. And a bull market means stocks are rising. And you can have a bull market in any market. So let me not just limit it to stocks. There can be a bull market in the bond market. There can be a bull market in gold. There can be a bull market in cryptocurrency. It basically means year over year growth in that particular market. Those periods can go 4, 5, 3, 7, 8 years. We have some very long historically running bull markets. But then eventually the piper comes to get paid and we have some form of a correction. Like I said, the market is not for the faint of heart. And a lot of times those corrections are sudden, they're abrupt, and they're steep. And then from that high that we've fallen off of, and we've gotten that correction or that crash, we normally stay below those highs that were previously ran up on the bull market. And that's what we call a bear market. It's a cold bear market. And that is what we are looking at right now. We are looking at a market that already in the first half of 2022 has been down as low as 24% from its previous highs. And I think right now, as I'm saying this program, we may be down for the year to date around 18%, 19%. The reality is, and I've said this on many previous programs recently, if you go back in the archives and look at our broadcast from the mid to late 2020, I started talking about inflation that was going to definitely come our way from all of the stimulus programs, as well as the fact that it's not just, let's not blame the stimulus program, because our government did a lot to try to help us during a very difficult time that we had to navigate. I got into financial services in the fall of 1997. When I first started working at Solomon Smith Barney, you could put money in the money market account and get paid 4.5% on that money. As I continued in my career, that number started to come down more and more and more. We went into a bond bear market. The interest rates and the price of bonds have what is known as an inverse relationship. When interest rates go lower, bond prices go higher. I'm going to say this very, very slow because I don't have a whiteboard to write it down for you. If you buy a bond that costs $1,000, that is the face amount of the bond, and that bond is paying a 5% interest rate today. And a year from now, every bond that comes out is only paying 3% interest because rates have went down. Do you think your 5% bond is worth more or less than the bonds that are now coming out? The answer would be it would be worth more. You have a bond paying 5%, and if I got new money and want to go buy a bond, the only ones I can find are paying 3%. Your bond is worth more. That is why as interest rates come down, bond prices go up. And the opposite is true. So right now we're seeing interest rates going up. That is making bond prices go down. And that is causing a bond bear market. The same thing is happening in the stock market. We talked about this last week. Interest rates go up, and it makes a few things happen that's none of them are good for the stock market. The first thing it makes happen, we look at the interest that we can get when we put our money in a money market account as what we call the risk-free rate, because we believe money markets to be risk-free. We put $1 in, we expect to get $1 back and some interest. The stock market, we know, is not risk-free. The stock market goes up and down and gives us nightmares sometimes. So the higher the risk-free rate is, the worse it is for the stock market, because I'm supposed to be incentivized to take on risk so that I can earn 10%. That's the incentive, getting that 10% earning, when my choice is putting the money in the money market account and only getting 1%. I'm willing to take some risk to get this higher rate. But when the rate for putting my money in a money market account is 4 or 5%, now I got to say to myself, wait, I can take no risk at all and get 5%, or take a whole bunch of risk just to get 10%. It may make me rethink where I put my money. That's not good for the stock market. Companies that are in business, and let's not forget, that's what the stock market is. It's a collection of companies that are in business. Well, when they go to bring a new product out, it costs them money. Where does that money come from? It either comes from money that they've already have on hand, or it comes from money that their consumers are spending and putting in their pockets. Well, once again, when interest rates are high, people are more likely to save their money than to spend it. So sales tend to suffer. Also, if you have money that is in your coffers, you have a choice now to launch a new product or do some research or leave that money growing. And then there is a third option for getting capital when you're a company that's bringing in money either through debt or equity. Well, if you want to go borrow money now and rates are going up, the money costs you more money. So companies in general don't do well in raised interest rate environments. So that's what we have going on. We have rising rates, which are suppressing both the bond market and the stock market. Cryptocurrency is such a new advent to the financial markets. People are still trying to figure out how this works. And I know it confuses a lot of people because you hear terms like blockchain and lightning contracts and lightning networks and smart contracts, and it gets to be a little unnerving. When I first got into the business, it was a matter of long-term care insurance. Long-term care insurance was a product that insurance companies brought out in the 80s, 1980s. They didn't know how to price it, so they guessed. And what they realized was that they were wrong. By the 1990s into the 2000s, the late 1990s, they had enough data to realize that the claims that were coming in were far exceeding the money they were collecting. And a lot of companies went out of business, and a lot of companies stayed in business and decided never to offer long-term care again. Why do I bring that up? Because it was a new product and it had its growing pains. Cryptocurrency is a new phenomenon. It has its growing pains. There are still people smarter than me, high up in finance, who can't figure it out quite yet. Is it here to stay? Is it not here to stay? Does it produce a value? Does it not produce a value? How do we price it if it does produce a value? They're confused. Now, if they're confused, and these are some of the smartest minds in finance, I know you're confused. Sometimes I'm confused with it. The reality is, though, I keep preaching the same thing about cryptocurrency like I do with every asset. You need to find out how much money you can afford to put over to the side and not worry about for the next 10, 15, 20 years. That is your investable bucket. And then you need to carve up your investable bucket into pieces: stocks, bonds, commodities, cash, and yes, cryptocurrency. Once you have that bucket, you put that money to work in each particular category, and you wait the 12, 15, 20 years. When that's the case, bear or bull market means absolutely nothing to you. It's a lot of noise. Let me give you a very simple example. Do you care if it's raining outside if you planned on sleeping in today? You don't unless your window was open or you have a convertible and you left your top down. What's going on out there has nothing to do with you. Conversely, if you were planning on riding your motorcycle tomorrow or playing golf tomorrow, you care if it's raining. That's the difference between someone who is investing and has 15, 20, 25 years till they need their money versus someone who is retired or is about to retire soon. Some of these things matter to us more than others. You have to find out who you are on this journey. For most of us inside the sound of my voice, we're on our way to retirement, 10, 15, 20, 25 years. We have time to survive this bull market just like we've survived other bear markets. We have time to survive this bear market just like we've survived other bear markets and wait for the return of the bull yet again. So to answer the question that's the title of this episode, bear or bull market, does it matter to you? The answer is it does depend. But if you are a long-term investor with a long-term time horizon and you have a plan that dollar cost averages into your choice investments, you're going to be just fine regardless of whether it's a bear market or a bull market. So I'm going to sign off until tomorrow night. Tomorrow night, we're going to be back on here with the Financial Power Hour. Then, as I said, I'm going on vacation. I'm going to take a week off from you cats, and I will see you back here on Tuesday, June 7th. Until then, remember what I always tell you: wealth is not only for the wealthy. You got